This is iBergamot on March 7, 2017. I show the original image I published back in December about winter tea that projected top dates all the way out to the end of February for the ongoing trend that started on the election. Actually, it started a little bit before the election, but it gathered straight after the election and had a little dip and continued to go higher. This original projection was later updated due to discrepancy in the dates, and detailed explanation about what's going on here can be found in previous editions of tea theory observations published in December and January. The winter tea forecasted top dates throughout February all the way to March 1st. And it happened. This tea is expired, it served its purpose, it was actually very precise. And what's surprising, majority of these time symmetry projections don't always hit the exact top. They hit close to the top, and some of them hit the bottoms, corrections in between two peaks. This particular winter tea had none of it. Every single top date was satisfied and the market went higher, and there were no significant dips. Such success rate is very unusual. Normally, some dates will give you bottoms and some other dates will give you tops. During the progression of this winter tea, there was a small tea nested inside of the winter tea. It's a nested tea, which actually not supposed to happen, but it did. And I published this image in real time just as it happened, and it projected a top date of February 27 or thereabouts, because we can never be sure about number of days in the future. Stockcharts.com don't account properly for the holidays. Now this one reached its conclusion also. We came to February 27 and the top was made 2 days later. See, this is the center post from the previous image. Oh, hold on. This is the center post from the previous image. And the time symmetry worked out, and the top was 2 days later, and it's March 1st, the latest maximum projection of the winter tea, a perfect hit, which almost never happens. Now, the way the nested tea was constructed, we took the advanced decline line of all common stocks, which I don't know who calculates this. Maybe these calculations are wrong. I can never be too sure. But it displays strange behavior. It breaks out right here, and then it just tucks its head in like a frightened turtle. And then it breaks out again, and it does it again. So maybe this is not the last low before the breakout. I mean, if we look at, this is S&P500 in black. This is some kind of a dip. This is some kind of a dip. This is some kind of a dip. For sure, it's already broke out. I mean, this is not a cash build-up phase. Maybe it's a period of rest, although this period was not very restful at all. So, but just following this logic, we have to consider two more dips in advanced decline line as the possible last lows before the breakout. Last lows before the breakout. So this one will project 33 days to March 17, right here. And this one will project 39 days the most to April 4. But listen, this is kind of stupid. The advanced decline line of all issues traded on New York Stock Exchange in red it's been going up non-stop. There were no periods of consolidations or anything. And this is so far up the trend. You know what it looks like to me? It looks like a stupid T I had a while ago. And if it is a stupid T, the kind of a T that we're trying to fit where it's not supposed to be, the kind of a T that I'm trying to fit where it's not supposed to be. There is no we. There is nobody here but me. Then one of these projections will be a low, and probably very close to the low. I mean, all these time projections have to be taken plus minus 10%. So 39 days, that could be April 4 plus or minus 4 days. That can make quite a difference, by the way. But I have a sneaky suspicion we haven't seen these time symmetries forecast the lows in a very long time. I think we're going to see it here. Remember the stupid T? The stupid T happened in 2015. That was the T with multiple tops in of the advanced decline line of common stocks only, similar situation. And then it made a low, and then it made another low, and then it made another low, and it just wouldn't break out. The damn thing would just go up and go down again. All during this time, stock market was doing absolutely nothing in terms of upwards movement. It was non-stop circle jerk. Nothing was going on. So this is definitely not the kind of a picture that we just recently had. However, the implications of the stupid T could be like so. The maximum projection of the stupid T actually hit pretty close to the low in S&P 500 back in the summer of 2015. So this is not a recent history. This is just an example of how this type of analysis can be taken to absolute absurd levels. I mean, I'm trying to peek into the future here a little bit. And my crystal ball is always a little fuzzy. There is a rate T that forecasts low in stocks, but that also has large margin of error, plus minus 4 weeks. Now we're in the middle, in the midst, right here of this period that started in February and will continue until May, where the low of stocks is projected to be, and then another one coming up in the summertime. Now, it could be lower low, it could be higher low, that I don't know. I don't know if it's going to be a deep low, a kind of a big 1987 style event. Although we have the recipe for that one is pretty much complete. I showed this way to look at advanced decline analysis earlier in one of my market movement observations. In this particular chart, I take advanced decline issues, make them invisible, plot 20-day moving average, and that's it. Very simple, straightforward way to analyze what actually going on New York Stock Exchange. Everything that's traded on New York Stock Exchange, the best stock market in the world, if the average is under the zero line in red, stocks are no good. When advanced decline 20 period exponential moving average of all issues traded on New York Stock Exchange, advancers minus decliners, if it's above zero line, stocks are good. Buy stocks, hold them, buy dips. If it's under the zero line, stocks are no good. Look. I do this, zero line. A little bit. zero line. Two touches, small ones. No big deal. We dipped and we came up. No problem, right? Okay. Now it starts. Now it starts. If I just avoid these little periods, there are plenty of time when the stock market goes pretty much straight up, straight up, straight up, straight up. Of course, there is a rub. The bottom will be made, but we cannot know. I cannot know if it's a bottom or not. You can never know that the bottom is being made when the bottom is being made. You can observe it very closely in real time, and that's what I'm trying to do. Because I don't think we're going into a big bear market. We just had one. We just had a bear market. We just had a bear market, and when I look at 5-year history of S&P 500, and I put Keltner channels on it. Upper channel, lower channel, mid dotted line. Keltner channel is a really good tool because it's based on volatility of that security that you plotted on. It's based on average true range, not on standard deviation, not on VIX, which measures nothing. No, it's a volatility of this particular security, and S&P 500 has been displaying a remarkable consistency of hitting upper Keltner band, hitting it, hitting, and then retracing somewhere to the neighborhood of mid-channel line, sometimes a little bit lower. And if it continues to hit upper Keltners, if it continues to hit them, it will remain in this uptrend, bouncing off rising mid-channel line until it will stop touching the upper Keltners like it did here and start sticking to mid-channel line, which is never a point of equilibrium. It's either a place to buy the dip or it's a breakdown and we're going much lower. And it's never cut and dry 100%. You cannot build a mechanical system on it. But you can say that in all these cases in 5 years, this is fitted to recent history on purpose to understand if I see things that are different than they just been recently. And it's not much different. It's not much different. Yes, this last rally came out much higher above Keltner bands than we ever did before, and maybe the only comparison that can be made is right here in 2013, in May of 2013. And there is of course risk of a situation like this black circle, where price continues to hug the upper channel and just keeps on going up, not giving a big enough correction to buy. I can make an argument that we've just seen it just recently at the end of 2016 and beginning of 2017, that this was such a period. Never mind that the Keltner band was a little bit away from the price, the persistency is noticeable. And I can adjust these bands so they will hug it more tightly. Nobody said that these are the settings that, you know, will last forever and ever. But the correction, normal correction, in a situation like this, repeating 2013 scenario, repeating 2012 scenario, I don't think it's 2014 yet. But even that one, I mean, this thing can go to 2200, even as low as 2000 on the S&P. And still be bullish as all hell. In the meantime, as of today, my account is 40% cash, and it's been cash heavy for the past couple of weeks, and I may sell something else. I will come back towards the end of March to revisit T-theory. There are a couple of interesting things brewing, and I think it's time I talk to them in the video, and to see what develops. Thank you for listening.